Hi everyone, welcome to the Timing Research weekly web show for May 16th, 2016. Today we will be discussing the 138th weekly report published through Timing Research. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com and you can download this or any past reports there. I have Matt Buckley back to host this week, so I'm going to go ahead and turn it over to him.
Hey David, thanks once again for having me. I'm extremely fired up again. This is my 20th session that I've hosted here with Timing Research, so extremely fired up to be here, especially on a day like today where we're bouncing around some key technical indices. There might be a bias to the downside, but everybody's asking the question right now, where do we go next, and is it up, as you saw in the survey. So today, excuse me, we have Dean Jenkins of FollowMeTrades.com, James Ramelli of AlphaShark.com, and Cameron Yost of TradingWorks.info. So another good group of 500-pound heads. We're going to jump right into it. Hopefully everybody's had the time to review the survey for today, and pretty sure that David has that up or usually brings that up so everybody can see it. There it is. But let's go top to bottom. Let's use that order throughout the day, folks. Dean, then James, then Cameron. Dean, why don't you kick it off? Tell us a little bit about yourself. Tell the audience who you are and a little bit about your background, and then currently what you do with Follow Me Trades.
Okay, well, thanks. It's great to be here. I think this is my 6th or 7th time, and I always look forward to this. This is a great show, a great panel. I always learn something from the other presenters. And so, again, I'm Dean Jenkins from FollowMeTrades.com. I'm sitting in sunny, surprisingly sunny, Olympia, Washington, just south of Seattle here. And I'm the founder of FollowMeTrades.com. I've been trading for about 20 years. Been doing my current system here for about 4 years, and kicked off this Follow Me Trade service. We offer education. We have some classes on options and on the trading setup I use, technical trading. I offer a stock picking service, and we're having a pretty good year. We're enjoying even a difficult market. And I just kicked off a live trading room. We've been open about a month and having a lot of fun with that. So that's who I am, and that's what we got going on. And again, good to be here. Thanks for having me on, David.
Okay, awesome, Dean. Appreciate it. James.
Hi, everybody. My name is James Ramelli of Alpha Shark Trading, based here in Chicago. It's actually also surprisingly sunny here as well today. It's, I think, the first time I've seen the sun in what feels like about 10 months. But here at Alpha Shark Trading, we focus on equity options. We have a live trading room where myself and 5 other moderators break down equity options order flow throughout the day. So basically what we're trying to do all day long is figure out what hedge funds, mutual funds, sovereign wealth funds, enormous pension funds are doing with their risk capital in the equity options market. We truly believe that that's the best way to get a sense of where big money and large money momentum is pushing things around. So on any given time during the day, I can take a look and see what big institutions are buying and selling throughout the day, and then use that to glean information off of that order flow that I can use to set up trades in individual stocks, ETFs, or indices.
Excellent, James. Appreciate it, and I love having you on here as well, fellow options trader, especially looking at something as critical as order flow, because as we all know, sometimes that remora on the shark just has some good living following that shark around and watching that those big chunks of options activity. So that's great. And Cameron.
Hi, Matt. Yeah, I'm Cameron Yost with TradingWorks.info. And I'm out in Colorado Springs on the west side, right tucked up under the mountains, where we've got a thunderstorm just rolling in and a severe winter weather watch for the next 48 hours. We could have 6 inches of snow here tonight. Isn't that amazing? A couple feet up on Pikes Peak. But I've been a trader pretty much on and off all my life. I had a Series 7 as a broker for many years up in Denver. And then through TradingWorks, we have assisted a handful of different software companies getting their products to market, and currently in transition, and I've just become a retail trader at this point, which I'm enjoying immensely. Is trading my own portfolio and pretty much focusing just on options. So we've got a good option group in here today.
Awesome, Cameron. Look forward to speaking with you as well and getting and picking your brain, so to speak. Ladies and gentlemen, if you don't know me, my name is Matthew Buckley. My call sign, so to speak, is Whiz. I flew the FA-18 Hornet for the United States Navy for about 15 years. Taught myself how to trade equity options back when I was a young officer, and I started applying everything I was learning flying the Hornet, having a strategy, being disciplined, managing risk, contingency planning, knowing when to get out of a bad situation and not being emotional about it, knowing when to declare victory and leave, as opposed to staying around and getting my my ass whipped, so to speak. So Top Gun Options is kind of some military-styled methodology, trading and live training and live trading as well, and we have an absolute blast doing it. So that's what I do. Before that, briefly, I ran the Options News Network. I was the founder and CEO of the Options News Network that was headquartered right there in the Chicago Board of Trade and the CBOE, the Chicago Board Options Exchange. And before that, I was the managing director of strategy for one of the largest volatility arbitrage firms in the country called Peak 6 Investments. So. And then today I live in beautiful Fort Lauderdale, Florida, where the crystal blue water looks great on me. So I'm glad you're having some good weather up there in some of the places you guys are, except Cameron. I guess you're actually out there where there's a small, very small community college that turns out Air Force officers, right? Up there in Colorado Springs.
That's exactly right.
It's a state school, right?
That's right.
Okay, so Dean, we'll go top of the order again. We'll start with you. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower from today's open to Friday's close?
Yeah, well, despite this this little bit of rally we got going on this morning, I think we're going to be down this week by Friday. I'll get into it when we talk about why and showing some charts, and I hate talking about the market when I don't have a chart in front of me. But yeah, down for the week for sure.
Okay. I'm not going to give you my answer, but I'll telegraph it. I couldn't agree more. James, how about you? What are you seeing either with flow, or how do you feel the market ends up on Friday, higher or lower?
Yeah, so I'm definitely pretty bearish this week, and I feel like I've said that every time I've been on the show over the past 2 months, and we haven't really had a big breakdown in the market yet. But if we take a look on even on an intraday basis or Monday to Friday, rallies tend to get sold. The market is not moving higher with any real conviction. We're rallying today, but not really to any level of significance in my mind. Based on the indicators that I'm looking at. The one thing that I think is going to be a real big drag on the market this week is we're starting to get into the tail end of the earnings cycle. We're going to get a lot of retail names that are reporting, and even though all of these stocks have kind of gapped lower already on the first set of retail names that have reported, we've seen all the rest of them move in sympathy. I still think that we're going to see some pretty bad numbers from these retail names this week, and I'm looking to get short all of those stocks ahead of earnings. It's going to be a big drag on the market, and overall, flow has been relatively bearish as well. I've been definitely picking up a lot more big blocks of puts that look to be speculative bets than I've been seeing calls. All the call buying that I see or have made note of over the past week and a half or so has been in stocks that have been getting absolutely crushed. So it almost seems like the only call buying we get is from hedge funds and institutions that are already short stock and are just hedging themselves.
Well, that's a great point. I mean, the net short. Saw an article the other day about Carl Icahn being like net 150% short. I mean, this guy is just all the quote smart money and hedge funds are short in the market. But that's a great point, and everybody should sit up in their chair and listen to what James said. Is like, hey, a lot of I'm seeing a lot of call buying here. It's they're either lottery tickets that people are just kind of scooping up, or they're hedging, as James said, to the upside. Because if you're massively short, you want to have a little bit on in case, I'm completely wrong, and let's not get totally destroyed, and maybe make a little scratch if this thing does go up, if everybody keeps smoking the Fed hopium. So Very, very well put, James. And Cameron, what do you believe we're going to look like by Friday, higher or lower?
Well, I'm going to say higher. I'm a bit of a contrarian here, so I'll be that. I'll play that role this week. Do you want more detail?
Okay.
At this point?
No. We'll get in your details in a couple minutes here. But the best part about being a moderator, that's why I told I send David a crisp couple $100 every once in a while to stay a moderator, is you're all wrong. Or actually, no, one of you were right, or a couple of you were right. It's the answer going last is lower in my opinion. I don't think we hold this 50-day moving average. The bias, as both you guys said, is to the downside, or a couple of you guys said, is to the downside. So I'm going, and I'll give more indications. I shouldn't have gotten into my indications yet. So the answer, of course, is lower. Okay, and now we'll go back to the top, Dean, and we'll start with you. What's your confidence based on which way you said the market's going to head?
Yeah, I'd give it a 75% confidence that we're going to be heading down here, just based on the, where we're at in market cycles and waves. Again, I agree with James. Retail earnings in general have been awful, right? We had the first time since 2008 we've had 4 quarters in a row of declining earnings, and Q1 were dramatically lower than the previous 3. So. And we got some bigger names. We got Home Depot and Lowe's and some other big companies coming out this week, and all indications are it won't be good. And so we saw some pretty big gap down on tech a few weeks ago, and then big retail last week, and probably some more coming. And I think they're going to just help lead the market down with discretionary, the consumer, right? And people talk about the Fed, but the consumer is still 2/3 of the economy. So. I think in terms of technicals and earnings, it's giving me pretty high confidence we're going to be heading down, maybe dramatically over the next few weeks. But this week, I think we'll close down. High confidence.
Okay. Sounds good. And James?
Yeah, I'm fairly confident as well. I'd say 75 to 80%. Like Dean said there, I mean, any company that has reported earnings over the last 2 weeks, if their business is selling things in stores, they have gotten absolutely crushed on earnings. And these aren't, normal moves that we would expect to see on a bad quarter. I mean, take a look at the way that Macy's and Nordstrom traded. Look at the way that Gap stores moved lower in sympathy with those names. I mean, these are massive, massive moves, and that's not a good sign for the economy, right? There's still quite a bit of brick and mortar out there, and if for whatever reason, if it's lack of traffic or just a move lower in consumer spending, not good for the overall economy. And I think we're going to get more and more and more info about that this week when Home Depot reports, TJ Maxx reports. We're seeing just today, I mean, it's only 12:15 here in Chicago, and I've already flagged unusual put buying in TJ Maxx, which reports earnings this week, Tiffany, AEO. All of these are retail names that I would expect to move lower this week on earnings or in sympathy with the names that are reporting. And we're seeing institutional put buying in those, like I said, Tiffany as well. All of that is kind of concerning for someone who I think would want to be long this market right now, because that covers kind of both ends of it too, kind of the lower end retail and the higher end retail. So if none of those are doing well in this economy, then what is? And I think that's going to become pretty clear this week when we get all these numbers. Okay,
awesome. Very, very well put. It's interesting. It really is a tale of two retails, in my opinion. Last week we got the retail sales and the University of Michigan consumer confidence, and those were blowout numbers last week. And it's weird to try and connect that with how bad some of these folks. Aeropostale a couple weeks ago, filing Chapter 11, and JCPenney always, JCPenney's is his Sears. I don't know if that counts, but and the fact that it's online retailers that are starting to crush it, the Amazons, as opposed to the brick and mortar. So it's interesting. I want to get into this a little bit more, but I like all that. So Cameron, what do you think?
Well, like I said, I think we're going higher this week, and there are two reasons why. I mean, I don't disagree with all the technicals. The fact that we've closed on most of the majors below the 50-day moving averages, and some are coming up on their 200-day. but as a contrarian, I mean, everybody thinks this thing is going down. And, you know, the market tends to surprise people. I also think that with option expiration here, the monthlies this week come to a close. And typically the market, you know, can rally or hold its own into expiration week. As far as the retailers, absolutely. The big box, I think we're going to see very disappointing. And it may, to the extent that that pulls us down. But on the other hand, with the Home Depot and the Lowe's, I think we all may be surprised. Housing is strong. People are, you know, who are selling existing homes are fixing them up. I think Home Depot, I mean, every time I'm in Home Depot or Lowe's, it's packed. You know, I can't argue with that. And today, I think the market's, I mean, on Home Depot, the market's telling us there's some, you know, expectation. What, Home Depot's up, what, 3 points already today? You know, they report tonight after the close, I think. So I don't know. I just think when everybody is saying short, I think the market is a dream crusher. It tends to disappoint a lot of people a lot of time. And I may be the one disappointed this week, but for the week, I think we're going to see it hang in here a little bit and close up for the week.
Okay. Like I said, I believe market's going to be heading lower by Friday, or lower than the open on Monday. And the main reason that I know for a fact that's going to happen is because I sent out a bear call spread on the S&P 500 that expires Friday morning. So I have to be 100% certain, otherwise I wouldn't have sent the trade out. So what was it? The 2080, 2085 bear call spread. I just don't think, and we'll get into the reasons in a second here, but I just don't think we have enough energy to really get airborne off this 50-day moving average. We saw a little skid along last week a couple times, and now it's just one of those little engines that's good, and then we're gonna head through it. So, okay, so let's go to question number 3. And we'll get to expand upon everything that we just talked about. So question number 3 should be based on any technical or fundamental or gut or anything professional that you all want to use. Let the respondents know the specific reasons that you believe that the market's going to be heading higher or lower in this coming week. Dean.
Okay. Well, Cameron, I'm glad to have a contrarian in the room to help keep it real here, man. That's always good. You know? It's always a little suspicious when we all agree too much, isn't it? All right. Hopefully, I'm sharing my screen now. You can see this right now. So this is the E-mini, the S&P 500 futures contract on a 60-minute chart. I like the 60-minute chart for what's going to happen this week. And we've already got, I'm really looking at this last bearish move, hoping you can see my cursor, but just over the last several days, pretty sharp move down, and really we've just started seeing the market come down after a pretty strong bear market rally. And this just looks like, if I just throw some Fibonacci retracements, this little pull up today just looks like just a quick retracement up before we take the next leg down over the next 3 or 4 days. And we got earnings coming out. We also got the Fed releasing their minutes on Wednesday, and that'll cause some volatility as well. No idea which way it'll go. Depends on how Janet Yellen parts her hair or what earring she chooses to wear that day, I think. But I just see this pattern forming, and I really see it more clearly. 60 minutes a little tough on the daily chart. Man, it is super clear. We are starting to put in, if you look here, last summer, I use Dow theory as part of my analysis. When we get a lower low, lower high, lower low, the sequence, that's the definition of a downtrend. We see it starting. We saw it at the end of last year, lower low, lower high, lower low, and then exploding down. We got that same pattern happening, lower low, pulled up a little bit. I think we're going to put in a new low this week, and that's going to trigger one of these another legs like we saw last summer at the end of last year coming. So again, I'm using Dow theory, Elliott wave theory, and I just see this next pattern for a down move setting up really, really clearly so far.
I like not being a contrarian when you're actually right. So well done, Dean. James, how about you? What's on your radar for the week that's going to convince you that we're heading inverted, just like the 30th anniversary Top Gun here?
So all of the technical reasons that Dean just mentioned, I think, make a really strong case just technically for a move to the downside. But like I said, my main focus this week is retail earnings, and I actually like what Cameron said about Home Depot there. I agree with what he said, but disagree with why the stock is up today. I think there is a lot of expectation for Home Depot and Lowe's. Those are two names that normally just crush it on earnings. I think over the past 3 years, Home Depot may have sold off 3 times on earnings day in total. So the expectation is for a move higher, but I think that actually sets me up here for a much better short play, because if they come in even just a little bit shy of estimates, or I think honestly, even if they come in line with estimates, people are going to be really loaded into this thing, and it could fall pretty hard. Same thing with Lowe's. If we take a look at the way the XHB is trading today, the Home Builder ETF, and over the past couple of days, it's been pretty weak. It's not a great-looking chart. That, coupled with all of the big box retailers that are reporting this week, which I expect to just have dismal earnings, I think is going to be a really tough drag on the market. And with that being said, there really isn't much else, in my opinion, that can kind of counter all of those bad earnings that I think we're going to get this week. There's not really a whole lot of macro data. We get housing starts tomorrow and the minutes on Wednesday, but I don't see anything on my calendar here that's a big catalyst that can rip us higher. And I think that in general, price action and price momentum has been setting up with a downside bias, and add in the catalysts, micro catalysts of earnings this week, which I don't think are going to be good. The lack of a big macro catalyst, I think, all of that is setting up for some nice confluence for a move to the downside.
I like that. That's a very well thought out and lucid argument, like the judge and my cousin Vinny said. So well done, James. Cameron, here's our contrarian for the week. Cameron, lay it on us, man.
Well, I can't. No, I can't disagree with what the charts are saying. I understand. I see that, and I think there's a strong. Everybody's got a very strong argument. I still think that I'm not saying we're screaming higher. I just think we're up. We're up 18 and a half points here on the SP, or the SPX today. The ES is up almost 18. I think we're going to stay in these levels this week. I think the market's played in the disappointing big box earnings that are going to play out this week. I think it's played in already. I just think we're going to chug right around here about where we are for the week. I think we're going to end up higher than where we were last Friday. But on the longer term, I'm probably a bit more bearish than being bullish. But looking at this week, I really think that we're going to just market's going to catch its breath, and I wouldn't go beyond trying to forecast. Let's look and see what happens Thursday, Friday, before we look at next week. But again, I just stay with it. I think that we could be surprised. It's just, the market tends to do that. Everybody's convinced it's going down. Everything points to it going down, and that's when it doesn't. It doesn't make any sense. It's not rational. The market's not rational.
No, it's a good point, Cameron. I like to tell the folks here at Top Gun Options, we're still trading here in bizarro market, where good news is good news, bad news is good news, and awful news is great news. That jobs report a week, the market was heading down, kind of drifting down all week, and I still put on a weekly options bull put spread with my subscribers, and I said, watch that. After the ADP report last Wednesday or whenever it was, it sucked. That the jobs, I'm like, this jobs report's going to suck. What were we looking for? 216 or whatever it was, the government number. It came in at 156, 154. It was awful, and that pulled the market right up. And a lot of retail traders and investors scratch their head at that. They're like, "Oh my God, I knew it was going to be a bad jobs report, and I thought the market was going to go down." I'm like, "You ain't in real market. You're in bizarro market." So that's what happens. You can't fight the Fed. Period.
Well, and I think Janet's going to have a lot more to do with what's going on. I think if there's any inclination that they're going to bump it in June, which they might, I think that could be the event that does push this over the edge. But
that's exactly, Cameron, why I think it's not going to happen, because I just don't think this Fed is, especially in the global economy, with every time she holds fire, she ripples off a bunch of reasons. I'm like, and most of them aren't necessarily just us. A lot of it, she'll throw a China out there, she'll throw a little Japan or maybe a Europe. I'm like, okay, I get, quote, world instability, but what about what's going on at home? So I don't disagree. I just think that my prediction, and we can ask Dean and James what they think. My prediction is that and she's not going to do it in the fall. There's no way in hell she's going to get in the middle of a Clinton Trump cage match and throw an interest rate rise in the fall. The Fed's apolitical. Exactly. They're going to sit on their hands. I think she gets one before the buzzer sounds on December 31st. So I think we get a December rise, because if they were going to bump it up a little bit in June, they're doing an awful job of preparing the battlefield. Usually they do a good job of kind of sending out her lieutenants out to some microphones across the country and prepping the battlefield. I think that would be a shock. So in that sense, Cameron, I think you're right. It would be if they did raise in June, that might be the one. Without a good prepping the battlefield from them, that might be the thing that lets the air out of this balloon. So I agree with you on that one. That's a good point. Dean or James, you guys, we'll deviate a little bit here, but this is a good conversation. What about the Fed in your opinion? Dean first, and then James. And besides the minutes we're getting this week, any Fed stuff that you're creeped out about right now, or when are you guys predicting an interest rate rise, Dean?
Yeah, so your comment, about good news is bad news is, whatever it is, we're through the looking glass right now because of the synthetic market that QE started, right, and the effect that hasn't ended. So, my approach, what I teach, what I trade is, we look that news is coming, and we know that news is going to cause a reaction in the market. I don't try and prejudge what that reaction is going to be based on whether it's good news, bad news. I just hold back and wait, because the reality of price action is going to tell you how the participants are responding to the news, and price and volume are the only realities. The rest is speculation, and price and volume will tell you what is going on, and then you can based on the moves that are made, the price patterns, using some pretty basic analytic tools, you can predict then with pretty high confidence what the next moves are going to be. So the news is really entertaining. It's fun to watch, but I don't. So what's the Fed going to do? I have no idea. I agree with your analysis. Probably, I think probably not going to get a hike this time because it hasn't been signaled. You're right. They're not going to get in the middle of the election. So if they're going to do one, it'll be late this year. How is the market going to respond to that? I have no idea, but they will, and it'll be dramatic, and it'll tell us, and then we can trade based on what the participants are doing. And I hope, I think we're in a long-term bear market. I've been saying that for a long term. After the 6-year bull market we had, it was amazing. We're starting to show really clear signs of a bear market starting, and that's more fun. You can make a lot more money in a falling market than you can. It falls faster than it climbs, and we're ready for that. And look, we got good setups that are ready when the thing turns down again, and it's going to be a blast.
Well, that's definitely one way to say it. It's going to be something, and a blast can either be good or bad. So we'll see which way that goes. James, how about you? What's your take on kind of the Fed? I know you pointed out the minutes this week, which was a good catch, but how about your Fed thoughts on all of this?
Yeah, I would agree with a lot of what everyone has already said here. I don't really care a whole lot about, and I absolutely hate the discussion that takes place everywhere before the minutes come out or before they have another meeting and announcement. One thing that I think everyone needs to sit back and realize is that they're not going to be dropping any bombshells. Like, it's not in anyone's interest for them to surprise us or to surprise the market. Nothing has been telegraphed about this upcoming meeting, so I don't think we're going to see anything significant there. You take a look at the last several meetings we've had. I mean, the changes even in the rhetoric that they use, like, minuscule. It's one reason or another why there isn't a set time for another rate hike. Matt, you mentioned there's always something, whether it's volatility in energy markets or instability in overseas markets. There's always going to be something. I don't think that anyone is going to be surprised when the next hike happens. I think it's going to be well telegraphed. We're all going to be able to see it coming from a mile away. And into that, I will look for my setups and plays based on what options flow is telling me. I mean, I'm really easily able to figure out what it is institutional money is doing in rate-sensitive names. I can figure out which ones they're looking to get long, which ones they're looking to get short, and figure out what their positioning is. But yeah, I mean, I typically don't have too strong of an opinion on the Fed, because I think it's kind of almost a waste of time or endeavor to position ahead of it, because especially when we're trying to play for something that we know would be very surprising and highly unlikely to happen. But it's easy to figure out what institutions are doing by looking at options flow, and I think that we'll get more than enough of a heads up when the time actually comes.
Got it. Well said. So we'll drift back to the main question, which we were talking about, in my opinion. So a lot on the flight schedule this week. I think one of you guys pointed out, but today there's nothing really other than treasuries or whatever long-term purchase. Was this? Isn't it China? Or yeah, difference in value between foreign long-term securities purchased by U.S. citizens. Blah blah. Quack quack quack. Nothing. Tuesday. Before the opening bell, we get building permits and some inflation and housing starts, and the cap rate and industrial production. So kind of pre-market-ish, especially after a day like today. The SPOO's up 18, almost 19 points. That is a big move in the S&P 500. A slew of data like this that are bad could kind of poke you in the giving some of what we're getting back today. The biggest thing I think that is going to hit us this week, we get some Fed minutes, as I think what James said. Crude oil inventories on Wednesday. Crude's starting to throw the markets around again, especially since Goldman Sachs came out with a report today saying, hey, oil production's going down, the rig count is going down, things are starting to get a little bad in the oil sector, which, remember, is good news. So bad news in the oil sector can actually be good for oil prices. And this is a story, but even though oil's rallying today and Goldman came out with a great report and all that type of stuff, I'm still taking a look this week at the OIH, the oil services sector. We talked about some bankruptcies in the retail sector. Let's talk about bankruptcies in the oil sector. Oil at $45 a barrel. No savior as bankruptcies pile up. This is, we had a Chesapeake scare recently. 3 oil services companies last week declared bankruptcy. I would get short the OIH. Even if oil went to, $1,000 today, Iran swims across the Persian Gulf and invades Saudi Arabia. Oil goes to 1,000. It doesn't matter. It's too late to help a lot of these companies, these Halliburtons and Weatherfords and all these mid-level ones, Schlumberger, that after you lay off about 50, 60, 70,000 people who, there's not too many jobs in America, folks, today that you can make 6 figures by just being a high school graduate. And those roughnecks, I've been to Midland, Texas. I've been outside of Midland, Texas. I've been to rigs. It ain't glamorous, but guess what? They get paid a lot of money. And when they get clipped, the little $15 a week you save in gas each week, you're not running into the Quickie Mart with Apu to go buy Slim Jims and 5-Hour Energy drinks with the $15 he saved. The $100,000 job that was lost is more of an issue there. So I'm keeping an eye on oil this week. It's a very long road to a small house trying to get to you. But yeah, I think along with a couple of you guys, looking at a lot of the retail sales is going to be interesting. And it's always interesting to see a Lowe's or a Home Depot really doing well, because it's not necessarily a sign of a good economy. It's a sign of what? People are out, they're cheap, they want to do it on their own, and they're not going to pay some handyman to do it, or somebody else to come in and do it there. So couldn't agree more with what everybody said that is going to drive the market higher or lower for the week. But I think keep an eye on crude oil, folks. Remember back in that January, February timeframe, there was almost a 1-for-1. It was a 90% 1 point correlation between crude and the market. Crude went up, the S&P went up. Crude imploded, the S&P imploded. We kind of lost that for a month and a half-ish, and now we're starting to see it come back a little bit, maybe after 2 months, that the market's moving with crude oil. Thursday, we'll get the Philly Fed and obviously weekly unemployment claims. That happens every Thursday. And then on Friday, nothing really going on here, existing home sales. So not a ton of macroeconomic data. There are some, Tuesday being a big win, and Wednesday crude oil reports. But the other thing that I want to cover that might move our market is a little bit of what's going on in the global economy. It really is a global economic week. We have the G7 meeting, which not that anybody's going to run to the microphone and completely destroy or rally the markets. Fed minutes we talked about, but also Japan. Every once in a while, a Bank of Japan Governor Kuroda appearance might freak the market the hell out. Hey, the guy didn't ease at all last time, didn't do any QE, and the Nikkei was down about 3% that day. So overseas central bankers, you should take a little bit of interest in. They're not super moving our market, but if it's a dull, slow news day and CNBC's looking for something, that's when they throw Japan up there. So, okay, so that is my take on what I am looking at for the week. Okay, let's move on to question number 4. And question number 4 is, what procedures, Dean, do you use to monitor and evaluate your trading results and progress over time?
All right. Well, I saw that question on the survey. That's a great question. So I think I measure 2 key statistics in my trading that I think are super important. And the first is, of course, the win rate. Win rate's important, but it can be deceptive. Probably the most important statistic I measure is what's called the payout ratio, and that's the ratio of money won to money lost on each trade, the average winner to average loser, because that's predictive of profitability. You can have a lousy win rate, you can be 30-40%, but if you got a really high payout ratio, you can be profitable. And you can have a great win rate, be 70-80%, and a lousy payoff and still be losing money. So I look at those together. There's actually tables you can plot those on, the risk of ruin tables, and they can predict whether you're going to drain your account to zero or be very profitable. And so I measure those 2 key statistics and try and maintain, above a 65% win rate and a payout ratio above 2 to 1. And if I can do that, man, we rock it. We are maintaining those stats and better, and that just predicts, really, really good profitability even through a variety. You can get a string of losers and still, if you're maintaining those stats over the long run, maintain some pretty good, consistent profitability. So that's my answer to that question. You brought up oil. I want to just show this chart. Like a politician, right? Sure. Take one question, then really talk about what I want to talk about. So oil.
You're hired. You'd be better than anybody we have in there right now.
Oh, don't get me started, man. So here's a weekly chart on crude oil futures, and we had this dramatic drop down from over the high on that was over $140 a barrel down to 30, and we saw this on the daily charts. We called this correction starting at 37.09, and of course we're up at 47.5 now. This is heading up with a really high probability into the Elliott wave 4 corrective zone, $60 to $80 a barrel before this is done. it could be this year and into next year. It won't go straight up. It'll be super volatile. But we really see this oil rally, and it's really just a corrective wave to that massive downtrend. We see this continuing. And super interesting is that natural gas is showing the exact same pattern. It's just trailing it by a few months. And so we are really interested in natural gas. A play we're just getting along on here is UNG, the natural gas fund. I'd really be interested if Cameron, if you see any unusual option flow, particularly calls on UNG, because we think this is going to, again, it's trailing oil by a few months, but it's going to do something very, very similar. So we're liking natural gas as a long play. So not all doom and gloom, right? We're short the indexes and some of the big stocks, but we've been long energy, we were long gold, we closed those trades, and now we're looking to get long on natural gas plays, and they're looking pretty good. There we go. I'll mute now. Back to you, Matt.
That's awesome. Back to you, Matt, in Florida. That's awesome. Thanks, Dean. James, how about you?
Yeah, so I look at my daily, weekly, and monthly net P&L, and that's really the way that I'm going to measure my success. I really like what Dean said about win rate and really how pointless and useless that is. If you want a 90% win rate strategy, I can give you one in 10 seconds, and it would be very easy for anyone to find one and make money 90% of the time. Just go find whatever puts on the SPY or calls that are trading with a 10 delta, sell them, and 90% of the time you're going to make money. But the one time that you lose on that trade, you might blow out your entire account. So it's really important to me to not really pay too much attention to win rate, but to always make sure that the trades that I am taking have a good reward to risk setup. For unusual options activity, that can be a little bit harder to define, but when I'm doing things like trading earnings or other catalyst events, it's really easy to set up spreads and define, a 3-to-1, 5-to-1, sometimes even 8 or 9-to-1 reward to risk ratio using different option spreads, call and put verticals, butterflies, condors, things like that. And I can actually kind of play, volatility two ways with that as well. There's some really great ways to set up iron butterflies and iron condors that give, a 3-to-1 reward to risk ratio. And I always say that for my earnings trading, if I could be right only 40% of the time and have that guaranteed, I'd probably give up my left arm, because, the trades that I am right in, I'm tripling, quadrupling, quintupling my money. So I think it's really important to pay attention to kind of the end of the day results and the thing that we're all doing this for. Although it is fun, we do this for money, and P&L is important. Win rate, not so much.
Yep, that's the scoreboard is what counts. That's a great point, James. And Cameron.
Oh yeah, I agree with everything Dean and James have said, and Dean's that payout ratio. I mean, that's an interesting term, but like James, I look at my, have I made money or have I lost money? I think the biggest challenge for retail traders like myself is to cut it and let it go. If you're in a loser, cut it out. Just leave. Just get out. There's another opportunity. And the biggest problem that many of us have, I mean, James is looking at setups and the risk-reward ratios, and that's exactly what good option traders are doing. But when you're wrong, in my attitude. If I see the first couple of days I'm in a trade and it's not working out, I just have to go. And that's psychologically the toughest thing that many retail traders have, is to let it go. I mean, you want this, it's going to come back. It's going to come back, and there's no reason for that other than emotional. We hate to really, you don't lose money, they say, until you sell it, but that's not necessarily true. I look at it every day at my portfolio value, and if I'm down for the day, I've lost money. That's what I've lost today, and I have to treat it that way. But again, I just come back to getting rid of my losers and cutting them loose. And whether you put a percentage play in that or a dollar amount for, depending on what your the size is that you're into. It's pretty much up to you as a trader, but getting out of a losing play is I find has been the greatest lesson that I've ever learned, and to cut those losses, because even you're right, you do a spread with a 10 delta and you could be a winner 11 months out of the year if you do an iron condors or something like that but you get one loser and you let it go, you've wiped out everything that you've done for the year. You got to start it back over. So that's where I'm at with that.
All right, that sounds good, Cameron. Appreciate that. Cameron hit a lot of good high points. Actually, all three of you did. I love hearing about the discipline. That's one of the things that I took from naval aviation, is being disciplined. The bottom of a lot of these oceans and the side of mountains are just smoking holes in the ground in the middle of nowhere, are from aviators who got emotional, who didn't get out of an airplane and give it back to the taxpayers when they should have. They did the old, I could save this thing, and now they're a smoking hole. When the F-18 left the production facility in St. Louis for the first time in the 80s, the emergency procedure section was a couple pages. And the reason is because it was just a bunch of engineers who wrote it. Like, well, these things might go wrong, and try this. Well, now it's about 90 pages. And we say it's 90 pages now because it's written in blood. There were things over the past 25, 30 years where people did, and it was like, well, that sucks, that dude's dead. What happened? And let's learn from it. And you're right, Cameron, is a lot of retail traders, oh, geez, Apple's, this Apple trade's going against me. Well, Apple doesn't hate me. It'll come back. Apple doesn't give a hoot who you are and will steamroll over you. The market can remain irrational longer than you can stay solvent. So if you're an emotional trader, you're not going to be one for long. You'll be dead. You'll be broke. In my world, you'd be dead. In this world, you'd be broke. That's why at TGO we kind of apply all those methodologies. And to your point, Cameron, as well, is we have a trading plan. Here's a 7-step trade plan. This is when I'm going to bail out of this trade for max profit or eject from in loss. I have a lot of folks who raise their hands when I meet them for the first time, and when I ask a room that says, how many of you have had a credit spread on, bull put spread, sold a bull put spread on the S&P 500, and a weekly, and it's Wednesday, and it's up $1,900, and there's about 300 left to go by Friday. 90% profit so far in 2.5 days. How many of you have said, you know what? I'd like that extra $300 by Friday. That's a better bottle of wine Friday night, and I'll just let it expire worthless. And then Thursday night, China comes out with some stupid macroeconomic data, and our market implodes on Friday. And you turn a 90% winning trade into a 100% losing trade. I feel sorry for nobody who does that. They deserve everything that happens to them. I deserved everything that happened to me when I did it. 25 years ago as an idiot beginner retail trader. So stand on the shoulders of those that have gone before you. That's the biggest thing. In the military, we call them lessons learned. Hey, last time I flew this mission, what worked and what didn't? Last time I made a trade like this, what worked and what didn't? And really stick to it. And James had an interesting take. Because, he doesn't. I don't want to put words in your mouth, James, but I think he said something like, I don't count win rate, I count P&L. It would shock many people on this webinar to know that professional traders who do use win rate up at peak 6, their mission objective was to win on trades 60% of the time. And I usually get a look from retail traders like, what are you, stupid? You guys don't want to win 100% of the time? And then I give them the reverse look of stupid back, like, are you stupid? Do you think you can win 100% of the time? That's what's so frustrating. So at TGO, I actually shoot for about a 70% win rate. But for all of you listening who just said, are you kidding me? Pros want to win 60% of the time. First of all, it's professional traders. I'm not talking about a hockey player. But if you're winning 60% of the time, kind of like James said, I think you actually said down near the 40%. If you could take that all the time, you take it 7 days a week and twice on Sunday. At 60% over time, you are crushing it. and you're going to be a very, very, very rich person. But if you stand up to the plate and point, to the outfield fence every time and you want to try and crush it, you're going to strike out. You might put one or two over the fence every once in a while, but you'll be broke before you get to those opportunities. So no swinging for the fence, being very, very disciplined, as Cameron said, is really going to help you out. But to James's point, I use P&L. Obviously, that's my scoreboard. I take a look at my win rate, obviously, and all that type of stuff. But one of my main things is just P&L. A couple of our portfolios that are $100,000 portfolios are up. One's 52%, one's 102%. That's on risk. If it's a $100,000 model portfolio, I'm not deploying $100,000 into the market. That's stupid. That's like somebody having a $60 billion hedge fund and being totally invested. Nobody is ever totally invested. So don't always put your chips in there as well. So I think that was a pretty big ramble. Does anybody have anything to add to anything I just rambled about? Or because I think you all had some great points, and I think they were all very, very pertinent to anybody. Dean, James, Cameron, anything else?
I'll jump in because both James and Cameron made points that I just want to echo. And the first was James about only putting on trades that have a high reward to risk ratio, and I certainly do that. I like that. I have no interest in a trade that has the potential of being 1-to-1, right, or 1-to-1 reward to risk ratio. I want to have the chance, right, based on my analysis, to make 2, 3, 4, 5x what I could lose, right, and then. Cameron's point about getting out of losing trades. I don't use specific dollar or percent. I use key support and resistance levels, and I let those, the distance between my stop, my predefined stop, which is that key support or resistance levels, and my entry, and then I let those define my position size. I just divide the difference into my risk control number, which is 2%. I'm only willing to lose 2% on any trade. So, subtract the stop from the entry, divide it into 2%. Okay, that defines how many shares to take, and if it hits the stop, I'm out, man. And whether you actually have a stop order on, people debate, about whether you should actually have a stop order on or have a mental level that you get out at, and that can be debated. But having a predefined entry level and the discipline to follow it, that's what I think. Having a consistent trade plan, trading your plan, having predefined exit points, whether it's a stop for the loser or exit points for the winner, and taking profit along the way, and then trading that plan, measuring the results, and then consistently doing it. Those are the keys, I think, to consistent profitability. It's worked for us, and I hear other pros who are still around, who still have money in their account, echoing the same things. Yeah, good stuff.
I'd agree with that. I'd agree with that, Dean. Since I went on a Gettysburg Address there and rambled a little bit, let's start getting to the close. And one of my favorite parts is this, because I'm going to pick your brain for a free trade, and I'll give one too. Not necessarily a trade, but what are you looking at right now? What do you like, either for the week or long term or the front month or whatever? Give us something that you really, really, really like. Wink, wink. Right now that you either have on or you'd like to put on. And Dean, will go with you.
Okay, yeah, I showed this earlier. I snuck it in, but I really like UNG as a long. I've got an entry defined at 706. I'm not in it yet, but I think 706 is a good trigger point where this uptrend is going to begin. And it's a corrective wave. It's a correction to the big downtrend that it's been in. But UNG at 706 is a go for me. We'll be getting long. Love trading that with call options. Just real simple. Probably the January contracts. Give it some time. It doesn't move that fast, but really, really like UNG as a long play right now, or when it triggers at 706. I like it when it triggers.
Okay, sounds good. I actually just wrote that one down. I appreciate it. Love getting free trades, Dean. Thank you, man.
And the stop on that, by the way. And I said I always have a stop. The stop is at 577. If we get in and it hits that level, a new low, then we're out. It's over. So.
Got it. Nope, wanted to write that down too. Okay, James, what are you looking at? What do you like?
Yeah, so one of my favorite setups for this week is going to be in Target on earnings. They report earnings on Wednesday morning, and the stock has a pretty dismal historical track record on earnings day. We like to look at how the stock performed historically on earnings day and from earnings day to expiry, and both of those measures are pretty bearish. The stock's only rallied 4 times on between earnings day and the nearest options expiry over the past 3 years. It's rallied 4 times. So it generally sells off from what we can tell. Order flow has been pretty bearish in this name. We saw some put buying in the May expiry options, which expire this week. Market makers are looking for about $3.50 worth of action by Friday in target, which would give me a downside measured move target of around 71.50. Right now, I can get the 73.5, 71.5 put spreads for about 50 cents through this week's expiration. They can be worth as much as $2 if the stock is below 71.5. So I'm getting 3-to-1 on my money in that position on a really short-term trade through the end of the week. I think it's a good way to get short something that has a catalyst this week.
Okay. Oops. That sounds good. Cameron.
Yeah, I like that, James. I like that short target trade. You know, as bullish as I am, I do think those retailers are going to get crushed, and I'm hoping Home Depot's not one of them. This morning I put a broken wing butterfly. It's a bullish trade on Home Depot. It's an earnings play, and it's a crap shot. So here you're going to limit your risk and hopefully have a little upside. And the butterfly is so 137, 140, 145 call. So you're going long the one, and these are this week. They're May 20s. Market makers are looking for a 5-point move. A little earlier today, it was down a couple points from where it is right now, and that's when I got in a little earlier. But so a 137, 140, you're shorting the 140 calls, and then you're going long the 145. So for the broken wing butterfly. Now your risk on that, if I'm dead wrong, I'm in for about, let's just look at one of these. I'm in there for about 45 cents this morning each, and my risk is $224 for each set of these broken wings. My upside potential, if this thing were to pin at the end of the week, about $1,200. So I'm risking $241, could make up to $1,200, and that's a good risk reward ratio for me. Of course, if it overshoots, my risk is over 1,000, but it's got to head up over close to 10 points from where it is today, and I don't think that's going to happen. So anyway, that's a little broken wing butterfly. It's bullish on Home Depot. It's an earnings play, and we'll see where we are. It doesn't take long to play that one out.
Okay, love the butterflies. Excellent, Cameron. Let me take a look at. Let me blast my screen out here. So, like I said earlier, I sent out first thing this morning a bear call spread on the S&P 500, and initially it was at $1.40, a weekly options bear call spread, and it got as high as $1.55, and then I saw it as low as $1. So the market's really trying to. That's a good indication that this market's really trying to. Hey, is this pop legitimate, or is it to be sold into? So I love the way it's kind of flopping around right now. I initially sent it out, like I said, at $1.40 to my subscribers. I think it's at $1. It's at $1.35 now. Let me show you the trade real quick. And I gave kind of my strategic mindset as to why I believe that we're heading lower this week, or at least not busting all the way up, getting close to that 2100 line. It doesn't feel like we're in the mood right now as a market to move up to a magnet level. What's a magnet level? 2100, 2150. That traders, the market and algorithms like round numbers. They don't like 2008, 0.75. It's just that's not a pin area. So 2100. I think as we were melting up about 3 weeks ago was maybe doable. I heard some people calling for it. I said, and now we're starting to roll over a little bit. So I'm selling 15 of this Friday's 2080, 2085 calls. Now, if you are new to weekly options, Danger Will Robinson. Remember that TV show Lost in Space? This expires The last day to trade this as a mortal, as a retail trader, is Thursday closing bell. SPX, I don't trade the SPY. I hate tag. Look into it. XPX versus SPY and the different tax treatment. That's why I don't trade SPY when people ask me. But this technically expires Friday morning at the opening print of all the S&P 500, everything that's in the S&P 500, all 500 of them. So just know for you as a retail trader, if you're going to do a trade like this, that's only during expiration week. Normal weekly options on SPX expire when? 6th, 13th, 27th, blah, blah, blah. But during expiration week, consider Thursday the last day to trade it. So this would be what, a 1, 2, 3.5 day trade right now if I can get filled, which I really want to because I don't. Now we're up to $1.42-ish. I've been chasing this thing around all day today, but as I stated for other reasons, folks, I just don't think we're. I think we're heading lower today. I think we get below that 50-day moving average, and it's not going to be pretty. So, okay, all right, guys. I'll tell you what. Dean, James, and then Cameron, tell us a little bit about where everybody can get a hold of you or reach you, or how to follow you wherever you are. So, Dean, we'll kick it off with you. Why don't you wrap up for us? Dean, are you there?
Hey, Dean, it looks like you're muted.
Yes, I was muted. Okay. I was trying to bring my website
and that,
up.
ladies and gentlemen, is the key to world peace, never to be heard again.
I was trying to share my website, and it is let me for some reason. Awesome. So it's real easy. www.followmetrades.com. You can got a free newsletter there. People can sign up, get market analysis, and contact us. So followmetrades.com. Love to hear from folks. Thanks. It was good to be here. This was fun.
Thanks for coming, Dean. We appreciate it. James.
Well, the easiest way to find out more about AlphaShark is to go to alphashark.com. There you can actually download our ebook on unusual options activity. It's actually a pretty good primer for someone who is maybe familiar with options but not so much familiar with the concept of reading order flow and looking for paper. So it's a really cool kind of simple guide to trading unusual options activity that I think you guys will probably enjoy quite a bit. Other than that, anyone in here can feel free to shoot me an email at james@alphashark.com. I get more emails in a day than I know what to do with, but can generally respond within 24 hours. If you have any questions and want to learn more about what it is that we do here, we have too many services and different products for me to cover now. So just shoot me an email, and I'd love to give you guys a little tour of what it is that we do.
Great, James. Great working with you again. And Cameron.
Well, again, as a retail trader, I don't have anything to sell, but I do enjoy visiting with people, and I do have a few people that I'm quote mentoring. But you know, the thing about this week here on the show, David, that you put together is you got 3 great traders and 3 great organizations, and I'm familiar with all 3 of you, and I think you're all great. But if anybody out there who's just trying to get started and trading options, and I've done some futures trading in the past as well, you can reach me, and I'll give you a phone call. Well, it's Cameron at TradingWorks.info. Cameron at TradingWorks.info. And that's the best way to do it. Just drop me an email, and I'd love to chat with you. And I enjoy being on the show. Thanks, David. And thanks all of you for your hard work that you all put in, helping us guys, try to get ahead.
You bet, man. Absolutely. Thanks for coming, Cameron. And finally, folks, if you're interested in jumping on board some of the live trade briefs we do throughout the week, usually on Mondays from 1 to about 1:30, I do my weekly options live trading session where I would have put out that SPX trade live to my subscribers. Instead, I blasted them a text alert and an email so they could get the trade the same time that I did. You can head to go.topgunoptions.com/FTM. That stands for Full Throttle Monthly. You can do a monthly subscription to what we do here at TGO. We have live trading, just about every day of the week that's skill-based. Whether it's a retirement portfolio, weekly options, a front-month portfolio, or a volatility arbitrage portfolio, you can find your porridge here, so to speak, here at Top Gun Options. And the way I did that is just based on that military methodology when I went through flight school in Pensacola. Primary, intermediate, advanced, and then all of a sudden you're a Jedi Master. So I'm no rocket surgeon. I didn't come up with all this on my own. I just kind of copied and pasted from the military, who can take somebody who has never even literally seen an airplane before, and in about 6 months turn him into a steely-eyed, fighter pilot flying onto the pointy end of a ship at night in the bad weather. So go.topgunoptions.com/FTM. That's for full throttle monthly, and you can get airborne with what we do here at TGO. So with that. David, thanks for having me, brother. You had a great group of folks again, and I appreciate you allowing me to host. So I'll throw the controls back to you, my friend.
Yeah, great show, guys. Thanks. Just want to remind everyone watching that you can go to TimingResearch.com and you can download the most recent or any past reports there. Also, if you want to watch the archive of this show or any past shows, that is at Timing Research as well. Also, for anyone who listens to podcasts, I set up a SoundCloud account this morning, and so if you go to SoundCloud now, you can search for Timing Research, and you'll be able to listen to all the future shows on SoundCloud, and I might post on some other podcast sites as well. So. And just a reminder, please go to TimingResearch.com/current survey this coming weekend to fill out the next survey and have your answers be part of the next report. So just want to thank everyone again. Dean Jenkins of FollowMeTrades.com, James Ramelli of AlphaShark.com, Cameron Yost of TradingWorks.info. It's good to have you back. It's been a few months, so looking forward to having you back on regularly. And, of course, Matt Buckley of TopGunOptions.com. Thank you for hosting again. Thanks, guys.